Welcome. Welcome, everyone. Welcome to The Law, Your Money, and You. I'm Roberta Saphire, an attorney in Sharon, Massachusetts.
Hi, and I'm Camille Barron, a financial coordinator and a healthcare advisor, also in Sharon, Massachusetts.
Yeah.
And today we have a very timely topic. As you know, inflation has been relatively high for 4 years. And now that inflation is coming down, we're starting to see a drop in interest rates.
Is it?
For the most part. Yeah. But we're seeing a drop in interest rates.
Yeah.
And everybody gets very excited about the interest rates dropping. So we're going to ask our expert today what this all means.
And we have a wonderful expert who's been with us from the beginning, and he's very fondly called CC for Cliff Caplan.
Right.
Did I say that right?
You said that right.
I never call you Cliff Caplan. I just call
Call
you
me
CC.
CC. That's correct.
Yeah.
Yeah.
And he's spoken to our Brighten Up for Financial Literacy groups. Every year they ask for him because they've heard of him. But anyway, Camille, first of all, welcome back. Welcome back.
Thank you. We've
It's
been
been a
doing
while.
Zoom calls for the last few years, so this is my
Yeah.
first time back in your new studio,
Yeah.
so it's
Well,
very
well,
impressive.
Tell us, viewers, a little bit about yourself, although they probably know.
Well, I've been a practitioner. I'm a certified financial planner for more years than I care to remember, since 1978.
Oh, boy.
And I pretty much have been in my own practice the majority of those years. But things have evolved over the years. In early stages, I would say that I was more involved in the accumulation and protection of clients' assets. And many of my clients have been with me 30, 40 years in some cases. Now we're on the protection and distribution phase, so it's shifted a little bit, and so it's been an interesting transition, but it's been great for me to really follow through with these clients for all these years, and then also work with the second and sometimes the third generation with children and sometimes grandchildren.
Wow.
So it's been a very rewarding career that I've experienced.
Well, something that should be really rewarding is they're talking about all these inflation, but what happens if and when the interest rates go down?
Well, the whole point, you have to go back and understand why interest rates might go down. So the Federal Reserve controls short-term interest rates, called the federal funds rate. The market dictates long-term rates. And Roberta, you're involved in real estate, and you know that mortgage rates fluctuate a bit. It's impacted and influenced by the federal funds rate, but it really is determined by market forces. So the Federal Reserve has a dual mandate. The first mandate is what you just indicated, is inflation, and their goal is to get core inflation down to around the 2% range. All right, and they've been succeeding. It's in fact, just a few weeks ago when they came out with the latest report, core inflation, which excludes energy and food, which can be more volatile, was over the last 12-month period was somewhere in the 2.5% range. So they're getting closer and closer. The other mandate is employment, full employment. And the unemployment rate has ticked up just a little bit. I think the last time I looked, it was about 4.1, 4.2%. And so they're sort of treading a fine line here with interest rates. And the key is what they call the real interest rate, or inflation adjusted. So, it's been at around 5.25% for about a year now. And there's all this talk about lowering it, and I think it's pretty clear they will lower it. The only question becomes by how much and how often, okay? And it's very data-driven. The head of the Federal Reserve, Jerome Powell, has always indicated that, and they're very proactive about this. So interest rates are going to come down. The question is how much, and I said how often.
Well, what's the present first mortgage now?
But the mortgage rates are probably, I guess, in a 30 years somewhere, I'm thinking about the 6.4% range. But remember, that's actually more influenced by the 10-year Treasury, and that's something maybe that might be a little bit, gets a little complicated, but it's really more tied in with the 10-year Treasury bond. And again, it's, as I said earlier, it's influenced by the federal funds rate, but it sort of stands on its own also, okay? But the whole point is when they lower interest rates, it's going to have a positive effect, all right? The question is, and there is a question, is about how impactful will that effect be? Because it does take a while for those reductions in this case to trickle through and really benefit the economy. It can take 6 months to a year. So we don't really know how long that'll take. And then we also don't know in what areas it will. You mentioned mortgages. Maybe that's impacted more quickly. It's more likely to impact shorter term loans such as car loans. Okay, that will have a much greater impact for the consumer. So yeah, they're on their way down. And as I said, nobody knows what's really going to stop. You hear rumors it may be, right now, as I said, it's about 5 to 5 1/4. Maybe they get down to about 4, 4 1/4 over the next year.
Yeah, so why don't we talk first about the impact of changes in the interest rates, how that impacts investors, and then we'll talk about consumers.
So that's a good question. So let me preface that. In the duration, in the entirety of my career, I've never seen this. Over the last roughly 12 to 15 months, I've taken in lots and lots of money from clients and saying, help, I've got all this money in the bank. They don't want to tie it up in CDs. Where can I invest it? And I've been investing it into 6-month and 1-year treasury bills. And at its peak, I was getting about 5.35% just a few months ago on a 6-month treasury, and about 5.15, 5.2 on a 1 year. And if you're in a state like Massachusetts with a state income tax, you also don't pay any state income taxes. Okay, so it's sort of been a slam dunk, a no-brainer.
Well, you don't pay state income tax on what?
On the interest from treasury bills or treasury bonds, any kind of treasury issuance. Okay, no state income tax.
You better put those millions in.
That's right. So now what's happening, well, as interest rates begin to decline, those rates will fall because those are really short-term interest rates. So for investors who benefited, and many of my clients did, we're going to have to look at other options. And what I have been doing gradually in anticipation of this rate reduction is putting investors who want fixed income, they want it safe, is putting them into longer duration bonds, in other words, longer maturity type bonds. And a lot of those bonds are yielding 5 to 6%. And what happens is that if interest rates start declining, even with those, what happens? There's an inverse relationship. If rates decline, prices go up. So that not only would you get your 5 to 6% interest on this, but if rates go down, you might actually get 4, 5, 6% of appreciation. So I think right now this is the best opportunity that I've seen for investors in bonds to make money in probably 3 or 4 decades.
And what term bonds are you talking about?
Well, good question. More in the intermediate term. A lot of people may be familiar, investors may be familiar with the 30-year bond. Wouldn't go that far out. A lot can happen in 30 years. I mean, 30 years ago, we had inflation, if you remember. Well, actually, maybe a little bit. Paul Volcker, some of our older viewers maybe remember him. We had an 18% prime rate.
I remember that.
Okay. So I wouldn't go that far up, but somewhere in the intermediate range, I don't know, 6 to 12 years, that, it probably makes a great deal of sense.
Okay. And how about impact on consumers?
So that's an interesting question. So again, Roberta brought up mortgages. Ordinarily, if you see a lowering of interest rates on a 30-year mortgage, you would automatically assume that is going to increase the demand for housing. But we have another factor here that sort of impedes that. And that's the fact that there's no inventory. Now, we're in Massachusetts, in the Boston area, there's no inventory here. In many metropolitan areas, there's just no inventory. There's a lot of reasons for that, and if we want to get into it, we can. But in fact, some of the interest rate followers have argued that lowering interest rates may actually increase demand for a lot of millennials who thought they were in a position to purchase a home. Lowering interest rates, more may jump into the fray. And what that may result, instead of lowering housing prices, which ordinarily is what happens, may actually increase them some more. And they've been appreciating as it is anyway.
Yeah, the housing prices are crazy. What used to be maybe 300,000-400,000 are now over $1 million.
Oh, housing prices are crazy. I look at in November I'll be in my house 32 years, and I just see how it's gone up, and it's crazy. But there's no inventory, and that's the problem. And in fact, you take a look around, and again, this is anecdotally in the Boston area. Perhaps you've seen the same thing. I don't remember a time when I've seen more building of apartment buildings, not condos, but apartment buildings. Okay, and that's simply they're trying to address the housing shortage, and that's very likely to continue.
Why is the housing shortage existing now?
Good question. I think it actually starts in 2008 during the Great Financial Crisis. And you might recall that was it was all it all occurred because of the subprime mess that happened in mortgages, where banks were lending money to people who didn't qualify for houses that were overvalued. And it became a house of cards and collapsed. And we may remember seeing pictures, especially in some of the Sun Belt areas like Phoenix and Houston, where whole neighborhoods were foreclosed and these banks would send out their landscapers to cut the grass. So what happened during then, home builders really significantly curtailed their building, okay, because there was excess inventory. Lumber yards also cut back in their production because, again, one of their main sources of business are home builders, and that continued until recently. And you remember, even before the pandemic, I remember, and I have to plead guilty on this, I thought housing prices, particularly in the vacation areas, were actually declined. And we saw just the opposite happen where they took off, okay?
Yeah.
And so you had massive appreciation. There's a lot of reasons for it. The stimulus, all the things that the government did that actually helped advance inflation. But the bottom line is that the markets have not yet responded to the demand for housing. And I just saw something the other day where roughly about 800,000, this is nationally, 800,000 new units of housing are being built. And the demand, if I recall, is something like 7 million. So there's a wide disparity.
Could part of that be the migrants coming in?
Could be, but I don't think so. I don't think most of the migrants, unless they're highly educated, I'm talking about legal migrants now, in a position to buy a home. Most of these people are just probably renters, especially the illegal migrants.
Well, one of the other things I don't know how much of an impact it's having, but corporations buying tracts of housing. People, they buy the housing, the people who live there can't afford to live there anymore, and then they turn around and sell the house.
Well, it's actually a little different than that, and you may not be aware, but there's some legislation that's pending in certain states to address that. So you're absolutely right. You've got some, private equity company, Blackstone, is people may be familiar. They're buying these homes not to sell them, but to rent them. They sort of look, they view them almost like a bond proxy, okay? And they're gobbling up these homes, and what it does is it's pricing individual homeowners. They can't compete with these big institutions out of the market. And so some municipalities are in the process of passing legislation, or at least it's being discussed. I'm not clear at this moment if any's been passed, but they obviously want to promote home ownership for young families. And so they're going to limit or even eliminate, I guess, we'll have to see how it all pans out legislatively, the ability of these institutions to actually buy these homes. They're buying tracts of land and building homes to rent, not to. I think with the fact that interest rates have gone up recently in bonds, because I said it's a bond proxy, this may promote or may be an incentive for them to sell some. But as I said, the municipalities aren't waiting. They're in the process of passing some laws to try to prompt and allow millennials and others to buy a home.
I wonder what kind of pushback they're going to get.
Oh, they're going to get a pushback. The lobbying effort in this country is huge, but the cry of individual homeowners and their constituents may prevail. That would be my bet.
Yeah, really.
Remember, this is not the federal government we're talking about. We're talking more in the state level.
Yeah.
Yeah.
Mm-hmm.
Yeah.
That's a phenomenon that's going on in other areas of the economy, like hospitals. More and more corporations are buying hospitals, even the ones that we're familiar with in Boston, the best hospitals.
Yeah,
Well, there's been consolidation going on, and then of course we have the whole issue, and it's quite prevalent in Massachusetts with Steward. And
yeah. You know what's funny? We had the president of Steward on our show years ago.
A different president than what they had recently.
I assume it's a different president, but it may not be. And he came with his secretary, and and they took notes and everything.
Mm-hmm.
And he was talking how they were changing from nonprofit to profit.
Well, I'm a capitalist, but when it comes to health care, I do believe that everybody has the right to have good health care. And one of the problems in this country is if we have the best health care system in the world, if you can afford it, all right? And that's the problem. And when you make it for profit, then it spins it. And we're hearing the stories now from Steward that are just awful.
Yeah.
All right. And so I really haven't come to a conclusion. In some ways, as a capitalist, you can instead of having everything controlled by the state or whatever else, it'll be more efficient, but it also may be more costly. So I haven't really come to a conclusion about what's the best way of going, but I do know that if Stewart is any indication, then we probably want to go back to nonprofit.
Well, the other thing too, even aside from Stewart, you have really great hospitals like Mass General and Brigham and Women's.
Yeah,
Who have
they're
merged, right?
And yes.
There aren't enough doctors.
Well,
they're
that too.
having nurses
Primary care
put
doctors.
on a jacket like they're doctors.
But the emergency rooms.
NPs, nurse practitioners have become much more prevalent right now.
Sure.
Yeah.
The emergency rooms in these really great hospitals, they are a nightmare.
I talk from experience. You're absolutely right.
I've talked from experience too. And the things that I've been reading, speculating on why don't they improve because they're short-staffed. Well, the return on investment isn't in the emergency rooms. It's on expensive operations. So they're going to they put the capital into doctors and procedures that bring in money, and that's the reason.
Well, you hear the price of some of these operations, and it's six
crazy.
figures for a 4 or 5 hour operation. It's just astronomical, astronomical. So yeah.
But anyway, back to interest rates. Some people have been asking recently about buying a car, and should they wait to take out a loan, or what should they do?
Well,
in the light of the interest rates
well, again,
going
you have two competing issues here. So if and when rates come down, and you take a loan, it's going to be cheaper. Okay. However, it's not like a mortgage. If you take out a 3 or even a 5-year note, it's not like taking out a 30-year mortgage, and you're not also not financing, hundreds of thousands of dollars. Okay, so it's a little bit different. But the other issue is that car prices have gone up.
Crazy.
Used cars, especially. I'm in the process. Interesting enough, I've had my car 5.5 years. I've got 67,000 miles on it, and I was floored what the resale is on this. From private, it's like $30,000.
Wow.
And so used cars have come down a little bit in value, but the fact is that they're still pretty high priced, and new cars certainly have gone up a lot.
that's crazy.
Is it a good time or not? I don't know. I think it depends on the make. I know, for example, without mentioning the brand, my daughter bought an SUV. She has 2 daughters, 2 young daughters, and she had a 6-month wait to get one of the more popular SUVs, and she had to pay over asking. Sounds like real
Okay.
estate.
Wow.
But usually the cars, they advertise that, no payments for 6 months. So
Well, that's all. Those are all giving. So it's like, I hate to say, it's like furniture stores. They, he's not going to, you're going to have any interest. Well, it's all factored into the price. Come on now, let's be honest about the whole thing. They're not in business to lose money, and nobody can blame them. But I wish they'd just call it the way it is.
Yeah.
And the other thing is, some people are asking about short-term bonds as an investment vehicle in light of the interest rates going down.
All right. So short-term, as I said earlier, as rates stayed high and until the Federal Reserve decides to lower the federal funds rate, short-term bonds were great. As I said, you were getting over 5% on both 6-month and 1-year treasuries, but in money markets too, and they include not only treasuries but commercial papers, CDs, and that kind of thing. When rates start coming down, and I don't think they're going to come tumbling down, and I think it'll be more measured, but when they start coming down, those that were attracted and pleased with getting 5% in money markets are going to be disappointed. And that's what I said earlier. This might be the time. In fact, this is what I'm doing for my own clients, is to lengthen the maturity on this, because when rates come down, as I said, it will influence longer term bonds, and those rates are likely to come down. And when that happens, not only you continue to get the interest rate on those longer dated bonds, but you also get some appreciation. So I guess the point is that if you want to, if I would look at it less as an investment as rates come down, and more as a place just to park money if you're going to buy a new car, if you're going to buy a new house, as a place just to park cash and be happy that you're getting real interest even as it declines versus what over the last 30 years. But I would tend to look at it less and less as an investment as interest rates go down. If you're looking to make money in fixed income or bonds, I would look to extend the maturity on those.
Oh, really?
Yeah.
Even though people may not want to make that commitment.
Yeah, well, you can sell those bonds. Don't forget, it's they're always very marketable. So even if you extend, if you purchase bond, or you can buy it in a mutual fund, an exchange-traded fund, you can always sell it, and you would still experience the appreciation that I think is forthcoming. So it's really not that big of a problem.
Okay, that's good to know.
Yep.
Right. So what else can you tell us about the interest rates?
Well, I do think that one of the things I'm telling my clients, so we all know that in the long run, stocks are going to make you more money than bonds in the long run. But there are periods, usually very short periods, where bonds actually outperform. And I think if we're not in it yet, I think it may be forthcoming. I think we're going to be in a period for maybe as long as 12 to 18 months where the performance or the returns on bonds are actually going to outpace the stock market.
How's that?
Really?
Well, because I think the stock market's starting to pull back a little bit. It's been led. The charge has been led by the AI stocks, artificial intelligence, and most of your viewers that are astute in the investment world know about NVIDIA, which has doubled again this year after being up like 244% last year. But it's starting to pull back finally. AI is a game changer, for better or for worse. We don't know exactly how it's going to work out, but the stock prices of a lot of these companies, led by NVIDIA, but there's AMD, there's others like Microsoft. They've done tremendously well because of some of the earnings that investors expect to get from AI. But I think it's going to pull back because it generally does, even with a new technology that is it's going to change our lives. And as I said with bonds, if interest rates come down, I said earlier, prices will go back up. And that's why I think that for a relatively short period of time, you'll see bonds do better than stocks. Now, again, when that's going to happen, I don't know. It may have started already for all I know. We won't know until we look
You're
back.
like an encyclopedia. That's an encyclopedia.
Yeah.
But again, for long-term money, I mean, you're still better off in the stock market. But the other thing about bonds, just to finish up, bonds have always been a ballast, sort of a cushion to the portfolio. But when interest rates are hovering around 0 to 1%, didn't really do the trick. Now, even as they come down, the interest rates come down a little bit, they do provide that cushion again that we used to look for in the past. And there's something called the 60-40 portfolio, 60% stocks, 40% bonds, which is sort of standard. I think that's back in play right now because of what's going on with bonds.
Well, the interest rates go down. Does that mean the bank will give the people who put like escrow funds in and that, will they be getting more money? Like right now, I think they get like 0.0000000.
Well, it depends. So you have to distinguish things. So the big banks like Chase, Bank of America, they've never. I have a business account with Bank of America. I get peanuts for interest. They never raised them as interest rates went up. All right. Other banks that are much more aggressive have given very attractive interest rates. All right. So one of the things about banks that, if you notice over the years, when interest rates go up, they're the last in line to start raising them. And then when they go down, in anticipation of when they go down, they're usually first in line. They're usually lowering them before they actually do go down. That's the way banks operate. Okay, they're always working on the margins. So I think you can expect when interest rates begin to decline, I think you'll see a pretty rapid decline, commensurate with the rate decreases.
The federal funds rate is not the same rate that people are going to get
No,
when they're investing. Can you explain what happens with that rate?
Well, it's a short-term rate.
Good question.
Yeah, it's a short-term rate, and and again, it basically is rates that banks lend to each other, or the Federal Reserve will lend to banks.
Is it the same as the prime rate?
No.
No.
No, prime rate's a longer-term rate. Yeah.
Okay.
So you don't even hear the term prime rate much anymore.
No?
Not
Prime
really.
rate's slower than the prime rate's lower.
No, it's higher.
Oh, it's higher?
Yeah, it tends to be.
Shows you what I know.
Well, it's and so again, it's an attempt to influence by lowering rates. It lowers the costs to banks, and hopefully they're going to pass that on at least to some degree to the consumers. Okay, as I said, in terms of like car loans are the best example I could use. By the way, I just want to mention, don't expect much relief for those that have credit card balances.
Oh.
Well, you know, some of these credit card balances, the interest rates are like 25%, which is just absurd.
Really?
And so maybe they'll give you they'll give you a haircut down to 21%. I mean, it's
Oh,
yeah.
that's
Oh
horrible.
no, it's horrible. It's
Oh.
horrible. You know, these credit card companies make money in so many different ways,
Do
and
you think it's mostly to the young people or the people in
lower
their
income, I'd say.
20s?
Maybe not necessarily
Oh,
younger,
lower
but lower income that are paying, you know, the minimum amounts. They love people paying the minimum amounts. They thrive on that. So, so that's not going to make much of a difference. But also the other thing that happens is that by lowering interest rates, corporations that borrow money now can borrow it at less, and that should help their bottom line. So there's a lot of obviously, you know, positive factors that go into this. But I do want to again reiterate that it does take some months for it to work its way through the economy, so that the people they sort of target, or the institutions and the consumers that they target, do in fact benefit.
Oh, really? Okay. That's good to know. So people can't run out the next day and expect a lot of things to
Yeah,
change.
there may be some aggressive banks. If I had a guess, and this is a guess, some of the online banks might be, they tend to be more aggressive in terms of interest rate and deposits, and also maybe in some loans. So that might be the first place to look. They don't have the bricks and mortar that, you know, some of these the big
Yeah,
banks
so
have.
somebody wants to complain and go down to the bank, they can't.
They can't.
Right.
They have to go online. Exactly right. That's right.
Yeah.
Well, we just got word here that
Yeah, I
we're
was
just
gonna
about ready
say.
to wrap things up.
Yeah, this is fascinating.
But this has been really informative. I'm sure that our viewers will even have questions now coming in.
Well, yeah. Well, there's a lot of questions going on. I said, and one of the biggest ones is the housing market, as you asked, Roberta. That because of on one hand, you have interest rates declining, which would usually in a normal economy would mean prices might come down. But in this case, with no inventory, the opposite may happen.
Yeah.
We just don't know yet. We're going to have to wait and see.
Yes. We just don't know.
Yeah,
Many
well,
times that's the
anyway.
answer.
Right.
Well, thank you. Thank you so much for
Always
being
my
here.
pleasure.
Yeah.
We'll
Isn't
probably
that
have you
wonderful?
back many more times this year and into next year, because the things are rapidly changing.
They most certainly are. We have an election coming up, and well, I don't think it's going to have the impact that many think. It will have an impact. I just don't think it's going to be as profound as what people think.
We want our viewers not to know what year we're in.
That's right. It could be any election, any year. But yeah,
Same.
so thank you very
Fascinating.
much for being
Yes,
here.
thank you.
We always learn from you.
Yeah, you're amazing.
Yes.
Yeah.
And I want to thank our viewers for watching today.
Yes.
Please let us know if you have any questions about this topic or any other topics maybe that you'd like to see us talk about on this program. Because remember, this is your show, The Law, Your Money, and You.